So I stuck there a lot. We don't stick with qualitative information a lot, but I think it's really important that you get that these aren't just some concepts to memorize. These are actually aspects that can really improve your life. So how can we use this information in managerial accounting? So let's go back to the course we're in. And so make or buy. So incremental costs are important in the decision to make a product or purchase from a supplier. So the question here is, do I want to purchase a raw material or purchase a finished good to go into my product, or do I want to build it myself? Right. And so costs include direct material, direct labor, and overhead. We've all talked about that, but we should not use, and we shouldn't use, just a disclaimer, the predetermined overhead allocation rate to determine product costs in these decisions, because it's a rate that we made ourselves, right? And overhead costs, we assume, are a sunk cost, right? We're gonna have to have electricity for our building. Even if we don't build something, we're gonna have to pay some kind of utility bill, right? We're gonna have to pay some kind of lease. So overhead is generally a sunk cost. It's not really irrelevant to decision making. But what is relevant, especially from a predetermined overhead application rate, if there's more overhead related to decision A than to decision B, that's relevant.
I don't think we can hear you.
You can't hear me? Hello? Can you
I
hear
can
me
hear
now?
you.
I can hear you.
Have I been cutting in and out, or?
Not for me.
Yeah, not for me either.
Okay, Whiting, I'm sorry about that. I'll make sure that the recording's available, because it sounds, I think my audio is okay. Maybe check your internet, because I think otherwise, but on break, we can try to worry about that too. Sorry about that, Whiting. So let's keep going. So the idea there is, right, we're worried about what's relevant, not what we predetermine. And so the idea here is we're making part 417. We assign at 100%, overhead at 100% of direct labor costs with the following units. And so to make part 417, whatever this might be, we have 45 cents of direct material, 50 cents of direct labor, factory head of 50 cents. And so this is a predetermined overhead rate. And the total cost to make is $1.45. And so if we do make versus buy analysis, we're saying we can buy the same part from a supplier for $1.20. So how much overhead do we have to eliminate before we should buy this part? And so we're saying here, we can't change the direct materials. We can't change the direct labor. What we have to figure out is how much, if we stop doing this, how much could we change the actual overhead? What's actually fixed, right? What's the sunk cost versus what is something that we can control? So we have to eliminate at least 25 cents per unit to make the total cost of making the component worth it. So if the incremental cost to make it is less than the cost to buy, we make the product. So this is true in a managerial accounting framework, right? We go through and say, should we build it ourselves? If it even saves us a few cents, we should. But we take a step back as true managers, and I would say, if there's a 5-cent difference, we might want to look at what's the administrative cost to making this. Can we be using the machinery to do something better? So we have to really look at, is a 5-cent savings really worth it from a business perspective? But for your homework, we're going to assume that it's a bright line test. A bright line meaning, if your make is cheaper than your buy, then you go with a make. If your buy is cheaper than your make, you go with a buy. But no, in real life, right? If I knew I could make a meal for myself for $5, or I could get the same meal for $5.50, there's a lot of other considerations there. If I could get it at takeout, I'd probably go takeout, because I could, with that time I save, I could probably make a lot more money. So, or I could spend time with my family, right? That's the decision-making process. And same with a business. Maybe we could use those resources for something better. So here we're saying, for this decision, we'll continue to make the part. And what we're saying here is we're able to drop the overhead cost to 20 cents. So if we're able to say that really the controllable costs here are actually 20 cents, then it's fair to make the part. But we have to strip out what's controllable versus what's sunk. So what we're saying here is, if we didn't make it, if we bought it, we'd still be liable for the 30 cents of overhead. There'd be still some kind of lease for a building or something that we would owe.